welcome everyone. Today we will be discussing about venture debt. With the ongoing so-called winter season, startups are finding new avenues of funding and financing, and amidst this, venture debt is the biggest source for them to go after, and we will see how other structures have been evolved over the years in India when it comes to debt. So before we get to that, let me quickly ask the speakers today to introduce themselves, starting with Ravi. He has founded a platform called 8VDX, which is very interesting. So I'd request him to just introduce about the platform and himself a little bit.
Well, thank you for having me here and giving me the opportunity to talk to everyone. So 8VDX is 8 Venture Ed Exchange. And Vijay, my co-founder, and I, started building it last year in partnership with Y Combinator. And what we are doing there is something very different than other venture debt players, which is primarily bringing capital to promising startups that are starting with the companies in Y Combinator, even before the venture capitalists, the equity guys, come in. And the reason we are able to do that is because of the tremendous success that YC has had since 2005. In which they have a demo day after their boot camp of 3 months, and thousands of equity investors log in and are able to fund these companies. So we are actually underwriting YC, not the companies itself. And on the other side, we have built a capital-light marketplace model where we bring in angel investors or HNIs to fund these companies with venture debt. So we are democratizing access to venture debt from institutions to angels. And prior to this, I was running 8 Capital, the credit platform, which I recently exited to start 8VDX. And I've started my career like most Indians who went to America as a programmer. And I did a mobile wallet startup in '99 with my partner, who now runs 8i, Vikram. And since then have been in hedge funds and launched 8 Capital in '05 to build a credit platform for India.
That's a very wholesome introduction. Thanks a lot, Ravi, for that. That gives us a good sense of what your platform is doing, and good to know that you guys come before even the VC guys come in, because that was the need of the hour. Happy that you all are addressing. And moving on to Apoorva, she's the partner at Stride, and I'm very happy to introduce you all to her. I'll let her introduce herself now.
Sure. Hi, everyone. I am a partner at Stride Ventures. I overall come with about 9 years of experience. Started out with HSBC in their investment banking vertical in M&A advisory and debt capital markets. Then I was a part of the Xander Group, which is a global private equity firm. I was part of the debt platform there, so structured credit across sectors and industries. I have been with Stride since the inception of the first fund. Stride is a venture debt fund. It's a category 2 alternate investment fund regulated by SEBI. This is our second fund journey. We've been very active over the last couple of years and now invested in about close to 70 companies across sectors, across stages. Yeah.
Yeah, well, everyone knows about what Stride is doing. Like you said, it's already invested in more than 70 companies. And I recently read about your report as well that you published on venture debt in India. Quite an insightful one. So moving forward, Abhishek, very glad to have you as well. Abhishek is a partner at Avishkar and leads the ESG First Fund. I'll let Abhishek introduce himself.
Thanks, Radhika. Hi, Ravi. Hi, Apoorva. Pleasure to be here. So just a brief background about myself. I've been with Avishkar now for more than 5 years, basically looking after new product, essentially new product development and new ventures, new geographies, and I've been essentially working on setting up a fund that would invest in Africa along with India. And the ESG First Fund is our essentially a first non-equity fund, and also a multi-regional fund which is looking to deploy across Asia and Africa. We did our first close early this year, so we really don't have a portfolio to talk about. Regarding myself, I've been with the firm 5 years. Before that, I worked for around 12 odd years working with Everstone and JM Financial, working in real estate, private equity, and structured credit, largely at JM Financial. And excited to be here.
Abhishek, for that introduction. Very happy to hear about your thoughts on venture debt and mezz financing, which you are doing currently, and get your experience onboarded for our audience to hear. So let's quickly move on to one of the most awaited questions: that how venture debt will pan out in these times of market turmoil. What is it that you all are looking at as funds, and how do you think the days look ahead, starting with Ravi?
Well, so the advantage debt has for companies is that it doesn't mark a valuation on your equity. So the headline that you should be thinking about is down round versus venture debt if you're a startup. So if you raised money at some ungodly amount of revenue multiple, and if you take a look at the exit that VCs look for, they look to public markets. And the public market valuations have come down for two reasons. One is because if you NPV the cash flows that a startup makes, which is 10 years from now or 7 years from now, and interest rates have all of a sudden gone up by 3%, 4%, the value of that money is a lot less today. So that is the first 30, 40% cut that people are seeing in the market prices. The second is because of the shortage of capital as a result of that, people have stopped spending money on Facebook ads, whatever else that they might be doing, startups to startup. And as a result of that, the earnings is lower, right? So, that's what we are kind of seeing in the market, people rationalizing where it's going to be. So from that perspective, the goalposts for Series A or Series B all of a sudden have moved by a year or two. So you need more funding than you had planned for. If you were raising money for 18 to 24 months, now people are saying raise for 36 months. Or if you have 18 to 24 months, raise another year. So either you go raise at your last round valuation, and if that was also unreasonable, then you have to do a down round. However, if you have traction and if you have the ability to raise debt, I would suggest to startup founders to think about that if you have the ability to get it done.
Yeah. I mean, that sounds fair from a valuation perspective as well, if a startup is going to raise money. But Apoorva, I'd like to have your thoughts as well on this, since you're already been heavily investing in companies through the venture debt route. How has the experience been, and how do you think will your fund specifically perform in these times of market condition?
So, absolutely, as Ravi was saying, I think it's a great time for venture debt because a lot of companies are looking at debt, and people who are not amenable to have debt discussions, even late stage companies who don't essentially have a debt use case like working capital or capex, are now open to have those debt conversations, largely because they're deferring their IPOs or equity rounds, primarily because they're not getting the valuation as favorable as they would have wanted to. So I think in terms of demand, there is a lot of pipeline for any venture debt player today, because a lot of companies are looking at augmenting some bit of debt. Even the companies which are well capitalized, they're also taking some bit of venture debt more as an insurance money. And then, of course, there are pockets which really need some bit of capital today in the current market, and they're finding it difficult to raise primary capital immediately at a good valuation. So I think it's a good time for venture debt. I also feel that there is a 50 basis point increase overall in the pricing that you can expect from your portfolio companies. And that's also just because of the demand supply equation here, that there are a lot of companies looking at some kind of debt opportunities today.
Got it. Now, Abhishek, you're into mezz financing, which is typically different from debt. But I would like to understand from you, how do you structure it, and how can startups benefit from such kind of a financing option?
Yeah, so it's not materially different, right, Radhika? So the idea is that, I think with both Ravi, Apoorva, and which we are trying to fill in the gap, is that we are providing non-dilutive capital. Founders don't want, they want growth capital. They are relatively riskier companies as compared to what a bank or NBFC would fund. And we are filling in the gap in terms of either coming in at a, like cash flow based financing, we are taking a regular coupon, or we are taking part coupon, and rest is getting built into the redemption premium, or we are taking a totally back-ended, which is a pure mezz kind of a structure. But the key need that we are filling in is that we are augmenting the capital pool that is available for early stage companies, which you are not looking to dilute their founders. Founders or the companies or existing investors feel that the company can do away with a dilution at this stage. It buys you a runway of 18, 24 months or 3 to 4 years. And this is what typically a mezz finance or a venture debt instrument would do. I have a slightly more exotic product in terms of from an ESG first fund, because we are looking at companies where ESG considerations are predominant, right? So these are the businesses where either environmental or social considerations are driving the value of the business, and these are generally and many of these products actually have demand in export markets. Right? So I look at companies which may not essentially just be startups. These are companies with 5-10 years of track record, but are looking for alternative source of financing apart from what is available typically to exporters, or very early stage businesses which are also have very strong ESG considerations, but generally the companies I am looking to target are typically, I would not rate them as startups. We by nature are looking at companies which have at least 3-4 years of track record of operations, and generally we are not looking at pure mezz structures. The idea is that if you are looking to make a early teens or a high teens return, you are looking to make at least 50-60% of coming through the group. And that's when we end up pricing the risk depending on the stage of the company, whether we want to be in an early teens or a late teens, or even a 20+ kind of an IRR where we believe the risk is our reward is commensurate with the risk that we are looking at. So as generally nature, we say there are two parts, right? We essentially have a company which has there are two things that I'm looking to get out of the company: my coupon or my IRR or my return on capital, and then my return of capital. And for us, return on capital, we need to have company having certain amount of comfort that company is generating X amount of free cash flow to be able to meet their coupon requirements, and it's not basically being met out of their runway, right? The funding that we have raised. And then on the return of capital, getting our principal back and some sort of a redemption premium on that. There we are relying on either a refinance risk, or we are looking at then a company has enough asset value or enough value in the business that it will be able to refinance. It's kind of, I would rather rate it as call it a structured credit product rather than a pure mezz. I hope that doesn't fuzz up the issue more than I was trying to clarify.
Thanks, Abhishek, for that. So my question to Apoorva is, how do you evaluate potential investee companies for venture debt, and is there any particular sector focus or use cases or stage of companies that you typically look at?
Sure. So we come in only once the company has, at least one institutional VC investor. The company should have raised at least $4-5 million of equity capital. That's the stage at which we enter. So, primarily Series A plus kind of companies are the ones where we are comfortable evaluating. In terms of use cases, of course, there are a couple of very prominent use cases for debt, right? The most important being working capital. So if you're a consumer company, you have some bit of inventory at your storefronts or warehouse, or you have receivables from your general trade stores, modern trade stores, partner portals, or there is some advance that you're paying to your supplier, your contract manufacturer. Similarly, if you're a B2B player, you'll still have working capital requirements, right? So working capital is a definite use case. There's also some bit of CapEx, acquisition financing. Some part of your acquisition financing consideration can definitely be financed through debt. Runway extension, think of it just as a complementary growth capital. You cannot substitute VC, but just adding on some bit of BD to extend your runway, preserve dilution, all of those things. So yeah, these are the primary use cases for debt. Even SaaS companies have started using some bit of debt, although nobody really thought that B2B SaaS companies would require debt. But if you are a product company, you have certain purchase orders, you have a confirmed order book, and there is some bit of front-ending of expenses, you can definitely take debt to fulfill those orders.
So most of
And we are
your,
sector agnostic. So there is no sector focus as such. We are sector agnostic, Series A plus kind of company. So pretty much sector agnostic, stage agnostic. But yeah, these would be the primary use cases. Largely, a thumb rule in the venture debt industry is 15% of whatever equity that you've raised till date. You can augment that quantum of debt on your balance sheet.
okay, how do you structure the investment, particularly the key financing terms, whether it is the interest rates or the convertible options? How do you typically structure for a startup?
There is no convertible option. These are NCDs, non-convertible debentures. So our debt definitely should come back to us. It's generally a 18 to 24 months, up to 30-month kind of a loan. The interest rates would be anywhere between 14 to 15%, depending upon how we perceive the risk. There is generally some bit of warrants. Warrants are equity options that are linked to your most recent round of valuation. And as and when the valuation increases, the investor can choose to exercise the option and book some bit of capital gain. So I think the debt would be between 14 and 15%. And there is generally 10% of the debt sanction amount equivalent of equity call options in the company. And overall, the expectation is that inclusive of warrants, the overall return should be around 18 to 20% for the investors.
And so typically the return IRR that you are also delivering to your LPs?
Yeah, it would be roughly 18, 19%.
Okay. So in terms of the warrants that you talked about, is it like the kicker that you exercise based on how the company is performing, and like a call option, when you choose to exercise that option, then the further capital goes into the company? Is that how it is structured? Or do
Yes.
you provide it upfront and then convert it like a option of converting into equity, like a typical consideration other than cash? Like you provide as a debt, like a sort of a CCPS type, or do you exercise right at the, like when you decide to convert the warrant, that's when the fund is transferred to the company?
So the instrument is partly paid CCPS. We do not block any capital upfront. It's in the nature of a call option. When the valuation increases, we can choose to exercise it. Generally, it's a back-to-back transaction to book the capital gains. The intention is more financial than becoming a shareholder and sitting on the cap table of the company.
Thanks, Apoorva. So, and Ravi, if you can elaborate your views on how do you see the structuring, especially now you work with the Y Combinator funded companies. How is that the structure different from what Apoorva has described, or is there something similar there as well?
So at 8VDX, we have a very different philosophy. Having been a credit investor for a couple of decades, I never understood why venture debt was more attractive than venture equity, because venture debt, your upside is capped to par, but your risk is same as the equity guys, which means zero. However, if you go later stage, and you select well, that's how venture debt can do well. But I feel that it's not as useful to startups if it's not available before the equity capital comes in. So that is why we have chosen to work the way we do. We have two different products. One is that we do the bridge to demo day for YC. The second product we have is what we call the continuity product, where we give a bridge to Series A. So again, it is a bridge going before the Series A comes in. Now, it may sound foolish to do these things, and that's kind of where the partnership with YC comes in, is that we believe that, well, we have seen that 99% of the companies raise money on demo day, so we can do that, as well as 1/3 of the companies that go through YC raise Series A. So the trick is, how do you choose those 1/3 companies? And for that, we have deepened a relationship with YC, where we invest alongside the YC Continuity Fund. We also have our own benchmarking portal where we collect key performance indicators from startups. And based on that data analytics, we choose the companies we believe should get funded with Series A. And all the debt that we issue is founder friendly in the sense that they're all convertibles. So we believe that in the early stage sandbox of bridge seed to Series A, there is no liquidation value. So even if I give them debt, it's just going to go to zero anyway. So I may as well convert it to some equity at a discount and play the Russian roulette there. So so that's kind of how it's structured, and we can go into more nitty-gritty if you like.
In terms of Apoorva, talking about the Indian companies whom you provide venture debt, what are the type of typical collaterals or any security that a company has to give?
So we are the senior secured lender. So we create charge on all current assets, fixed assets, intellectual property, brand, etc. of the company. Of course, most of these companies are technology enabled. They are asset light. They'll not necessarily have plant, machinery, equipment, to mortgage as such. But yeah, they'll have a very good asset of a very good pool of current asset in terms of inventory, receivable, advances, etc. And typically, when venture debt comes in, we also see what kind of capitalization levels does the company have. How many months of runway does the company have cash for? So that's also a very big comfort for any venture debt player. Yeah, so it's generally basically we are the first in the waterfall. There's nobody above us in the liquidation preference.
One question came from the audience is basically, do you take, after having recourse to the company's current assets or the IP assets, whatever is can be liquidated, do you then have a recourse into the guarantees provided by promoters or the directors of the company?
No, taking personal guarantees from promoters is not a standard in this industry. And anyway, these are professionals. Whatever they have would already be invested in the business. So we don't see any meaningful benefit, by getting personal guarantees, and that's a non-standard clause in this industry. So we don't.
That's what I think is the provide some edge to venture debt above the banks, because when banks do the lending, they eventually end up getting the personal guarantee of the promoters and directors as well. So, and that's where venture debt, despite a slightly higher interest rate, comes into makes it a little bit more amenable for startups, notwithstanding other factors. So, okay. If you can, I'll ask this question with Ravi and other panelists. How do you see the venture debt market opportunity in India, and how big can it get? Because one of the reports we saw in the strides, unlike in the US where 20% of the overall venture funding goes into debt, in India it is still less than 2%. So how do you see the market evolving in India over the next few years?
So if you're asking me, I think it's just the maturity of the venture market, right? So globally, venture last year was about 300 billion, and 10% of that was in venture debt. If you look at Main Street, which is Wall Street, the debt to equity of a normal company would be much higher than that. They would be around 2 times debt versus equity. And as the software economy matures, with the kind of business models that Apoorva was talking about, with revenue-based financing, FinTechs, et cetera, which are balance sheet heavy, more and more debt is required to grow, because using equity to fund your balance sheet, et cetera, becomes too expensive. Now think about it, 10 years ago, 20 years ago, you would buy a Microsoft Office CD and pay $200. Today, you pay $365, $6 a month, or whatever it is. And therefore, the revenue streams are much more predictable. And that is why, if you take a look at the price of Microsoft equity, it has gone up dramatically. And that's one of the reasons. And because you have predictable cash flows, you can therefore securitize them. That is why one of your questions that you had is, how is the revenue-based financing different? Is it's working capital, basically, what you're getting. Whereas, venture debt is on top of your, it's a corporate debt versus financing your revenue stream. So I feel that in India and even globally, especially after the valuations will come down, there is going to be a more demand if venture debt is available. We are seeing early stage venture debt coming in. Of course, we are very early, but we have seen recently the likes of Mercury come in and say that if you raise $4 to $5 million, they'll also give you debt. So we'll see where it goes, but I'm actually very optimistic, because the quality of the companies have increased so much over the last decade or so as far as startups are concerned, that we should be able to see more and more debt. And as founders get more educated about debt, I think the biggest issue that the venture debt industry has is the debt is itself such a bad word. And that's because of the fact that they can put your company into bankruptcy. And most startups have to pivot at least once or twice, because as the market conditions change, et cetera. And if you don't have room to pivot, i.e. you have interest payments and principal payments, you're going to go bust.
And so in terms of like, in terms of other challenges that you see in the Indian markets, like venture debt has grown quite a bit in the US, but what are the other challenges other than the pivoting equation that you talk about? What are the other challenges which entrepreneurs in India face when considering the venture debt? Is it availability? Is it the terms they feel are onerous?
It is onerous. The interest rates in India are high, right? So that's 14-15% debt. It is pretty high. Most companies cannot afford to pay that. Of course, if it is a PIK, pay in kind, then you are again paying it forward, if you will. So availability, I think there is enough demand. I don't think that I see thousands of crores being raised by venture debt companies. I think there is just not enough venture debt players at the moment. The more people that come in, like Stride and others, I think you're going to see more and more demand.
What is it that really takes, funds to start venture debt? Who are your typical LPs? Because at the end of the day, the fund stands on the LP money, right? So what is it that really would increase the number of venture debt players in India? If we can maybe start with Ravi.
So we do have, interestingly, in our platform, we have several HNIs and angels who have signed up from India who are providing venture debt globally using the LRS route. So, and I know, for example, that most insurance companies, State Bank of India, LIC, if you know how to approach them, they will give you money. Apoorva and Abhishek are probably a better, suited to be able to tell you. From an 8 capital perspective, we never raised Indian money. So my brother, however, in 8I, he does raise money from Indian institutions as well as angels. Anecdotally, I think most of the money that is there in Indian venture debt is raised by wealth management companies, and they take a large percentage upfront to get to their network of HNIs. But I may be wrong.
Got it. And Apoorva, how does the fund structuring look at your end? Who are your typical LPs, and how do you get them to invest into your fund?
Sure. So, it would be a mix of institutional investors, banks, life insurance companies, of course, Government of India through its SIDBI fund of funds vehicle is a key segment. Then a very big segment is family offices. For an asset class like this, family offices find it very interesting because it's a good exposure to the new India, new age businesses. It's sector agnostic. You get flavor of different kind of companies. It's a good foot in the door to understand some kind of sectors, even if you want to, become an equity shareholder in those companies. And third would be HNI money. Most of it for venture debt players in India is domestic. I think the international capital pool is not really well explored in the venture debt ecosystem. And yes, as Ravi was saying, a lot of it is, through wealth managers as well. There are some very good wealth managers who distribute the asset class asset for you in their investor base. But yeah, it's a good mix of institutional investors and family offices, and far lesser percentage of HNIs, because the minimum ticket is 1 crore for any AIF category, and all any fund would want their average ticket size of investment should be at least 4-5 crores.
Yeah, that's right. I mean, looking at you speak, I'm sure the LPs are quite happy. They're reinvesting in the fund. So, but Abhishek, why don't you tell us how the LP structuring looks at your end? You're on mute, Abhishek. We can't hear you.
I just read a message from someone that my audio was not clear. So I don't know whether I'm audible as of now. But so see, I can't speak to venture debt, but there is our fund is not Cat 2, so essentially it's domiciled out of Luxembourg. So we are essentially looking at institutional investors who are global, and this includes given the mandate of our fund, and given Avishkar is also an impact first investor. So we continue to tap into DFI money. We continue to tap into pension money. So need for a self-liquidating and debt kind of structure instrument, there are enough institutional investors who would be interested, as long as we can demonstrate the returns are are commensurate with the kind of risk we are taking. So, it could be, if you look at overall Avishkar's LP pool, it's a mix of institutional investors, DFIs, pensions, and now increasingly Indian institutional investors as well. Apart from the same old like SIDBs and NABARD, but we are now seeing an increased interest from HNIs and family offices in India as well. So it's a fairly diversified family pool. Just for ESG First Fund, right now we are a single LP fund. We are looking to expand it to include more investors as we grow in size.
All right. Abhishek, sorry, your audio was not very clear, but better than before, of course. So if you could just use earphones from the next question onwards, I think that will be better. But coming to Ravi, we have an interesting question for you from the audience. People are saying that what you're doing is very unique and interesting, like we said in the introduction as well earlier. But they're asking that what do you do when the money that you give to these startups, what if it's not repaid? What if there's no cash to pay? How is it that you function in that case?
I get very sad. No. So, well, I'm going to say this, that at the end of the day, what we are doing is completely different from a traditional venture debt side, right? It's a bridge. Just think of it as a bridge. So it's a bridge to nowhere sometimes, and sometimes it's a bridge to getting your money back. So we have analyzed a lot of YC data, and including companies like Coinbase and OpenSea, even Airbnb, nobody understood what they were doing when they actually went to demo day. So they failed to raise money. And these companies, in our case, would have converted our principal to equity. I think I'll be okay with, even if we get one in the next decade like that, I think we are cool. So that is kind of the model that we are working with, is that over a period of time, we are going to see some companies. So in our model, 20% of the companies can convert, and we will still make money. And the reason for that is we do take equity upside in these companies. And the returns that YC generates from their companies is phenomenal. So if we get a small portion of that, I think we'll be okay. And in our bridge to Series A, we are more stringent. Our underwriting is much more stringent, and we are actually underwriting companies. And in those cases, we don't allow the companies to convert. We decide if we want to convert. Otherwise, we just stay on top of the capital structure, but we do not enforce. And the reason, again, is there is nothing in the company to enforce. So we keep the debt on top of the cap structure in case there's an acqui-hire, or something happens and the company turns around and we start seeing amazing traction. And then we might take a consideration, okay, we will convert it to equity and see where it goes.
So, and staying on with this question with the other panelists, Apoorva and Abhishek, what are the instances have you seen of, or percentages have you seen company defaulting on those venture debt after you have taken all the recourse and all that? So, or before even declaring a default, company is missing the payments or repayment schedule. So, what are the instances typically you see, and have you witnessed any overall defaults in your portfolios?
So with respect to Stride, there has been zero delays, no delinquency and zero delays on interest or principal servicing in any company since inception across both funds, across all our 68, 69 portfolio companies. And overall, if I talk about the global asset class also, I think venture debt has shown a lot of resilience. And, in the last 20 years or so, the loss ratio historically globally has been less than 2.5%. Within India, it has been less than 1% in the last 5 to 7 years of its extensive presence in India.
That's a pretty impressive track record, because NPA, if your NPA is less than 1%, that's actually performing better than some of the regular commercial banks in that sense. And Abhishek, in terms of your mezz financing, do you also have a near zero NPA levels, or is the story a little bit different?
I have zero NPA levels because I don't have a portfolio as yet.
So, you don't have.
I can match Apoorva's performance that way, but I don't know whether I'll be able to match it 2 years hence. But we'll have to see how it goes, because generally it is in the performing credit range, but it is still expensive. So you factor in certain amount of default, and We are, and the kind of market we are entering into in terms of funding, we do expect, right, fundraisers to get delayed. We are also, part of the repayments and refinancing. Our repayments are subject to company being able to raise money. So we do expect, right, these, this kind of scenario, at least in my portfolio, I'm not expecting that it will remain totally delinquency free for the coming year. So we need to factor that in and accordingly pricing the risk.
And my question to all three panelists, I will start with Apoorva, is have you seen any instances of secondary transactions in venture debt or refinancing of the debt that has been provided?
So, venture debt is amortizing loan. We don't do bullet loans. So in that sense, of course, some part of your repayment would have already been done. And if you find another lender, although it's not very common, unlike performing credit, real estate, where refinancing is a very, very common phenomenon, you will not see that in venture debt. But yeah, it can definitely happen. Why not? It can.
And what about secondary purchase, like another venture debt, just like you have secondary market for private equity? So you see that in venture?
I haven't seen any instances. Venture debt is still very nascent, right? There are limited players. The market is limited. I haven't seen that kind of uptake in secondary transactions. But yes, refinancing I think is very much possible. Not very common, but definitely possible.
Ravi, in your experience, you have come across, especially in the YC domain of companies going for a refinancing or a secondary transaction on the venture debt?
So 100% of our loans are refi because these companies really don't have revenues when we first give them money. And so our evaluation is, are they going to be able to raise their next round? And then we fund it to that. Versus traditional venture debt players who go for a little later stage because they have revenues. They're looking for two things. One is, can they repay using organic cash flows? But more importantly, if you have raised a large enough round, say for 24 to 30 months, the venture debt players only fund you for 18. So they're really taking your equity money away from you. It is giving insurance to the founders so they can grow quicker and augmenting their venture round rather than using venture debt to grow, to replace venture equity, if you will. And it's a smaller amount, as Apoorva said, 15 to 25% of the venture equity. So on the secondary side, the term or the duration of venture debt is too small for it to be refied. And it's very difficult to sell venture debt because it comes attached with warrants, etc. So what you could do, and what we are envisioning in the future that our platform will allow us to do, is to split the equity upside from the debt and trade that bit on the secondary market.
So, okay. And in terms of like a single most important, like we talked about different situations when your venture debt, where a company may opt for a venture debt. The most common theme that I hear about is extending your runway or coming as a bridge to your next round of valuation. But aside from that, what is the the most frequent use case of the venture that you have seen? Aside from extending the runway.
It's just money, right? When when you need it. So from our perspective, we are the first money in, and therefore it's important money. And if I was to put my startup hat on as a founder, why would I use venture debt? I think I would use it because it's cheaper than equity.
In your case, what's the most common utilization of the venture debt among your portfolio companies?
Yeah, so working capital is the most popular use case, and as Ravi also mentioned, any kind of expense where there's a net asset getting created on your balance sheet, whether it's capex or working capital or some bit of acquisition financing, right? You must use some bit of debt in your capital structure, because we've seen companies reaching Series D, Series E stage where the founders are reduced to single-digit shareholding because they never took any bit of debt. And for use cases like working capital, capex, etc., it's actually criminal to use your equity money for that, because equity is definitely the most expensive form of capital.
One question from the audience is, can it be used for acquisition financing? And I'll add a little bit on top of, can you use the venture debt to do a typical LBO type of transaction if you are acquiring a smaller competitor?
Yes, you can use it for acquisition financing. There is no end-use restriction in venture debt, unlike bank debt, right? So there's no end-use restriction. And think of all Thrasio-like models, right? Those are essentially LBOs, whether it be, all the big guys, Mensa, Global Bees, whatever it is. So end of the day, all of those guys are acquiring these profitable brands in entirety or majority, right? And bettering their inventory management, their performance marketing, their branding, and increasing their sales. So all of that is essentially being run through a mix of equity and debt.
Cool. So Ravi, we have another question from you, for you in the audience. They're asking as to what are the top 3 factors you consider while you pick an investee company? You're on mute.
The number one factor that we look at is their ability to raise their next round of funding, because that's how we get repaid. That's pretty much the only thing we care about. We're sector agnostic as well. There's no 2 and 3. So Amitabh, there is no
Very straightforward and to the point, crystal clear. But Apoorva, what are your considerations? What does your fund look at?
So of course, it has to be backed by strong institutional VC investors. They should have raised, as I said, at least $4-5 million of equity. We don't want to take any technology risk, so we'll not go and invest in a Web 3.0 or a crypto or real money gaming. So in that sense, debt has to be in a company where some kind of product market fit is established, right? We look for a certain baseline of revenue, at least 2.5 crores monthly revenue. That's where we get more comfortable with. Yeah, so broadly these.
Got it. Ravi, like I understand from your model at 8PDX, you're also fund startups which don't have any backing so far. So how is it that, you look at while investing, you don't look at any revenues that they make, any cash flows they generate?
So as I mentioned, to start out with, we have 2 products. One is a bridge to demo day. And we also have, and this is again in partnership with Y Combinator. And we also have a unique product with Y Combinator where half the YC class is now international. And YC will only invest in companies which have re-domiciled themselves to America or Singapore or something. And if you're an Indian company and you're re-domiciling yourself to America, that's a 90-day process. Until that happens, YC does not give you a single cent. We can step in and give the Indian company money using our FBCI license. We have the ability to do that today in many countries, including Mexico, Nigeria, Brazil, UK, Australia, Singapore, Indonesia, and others. So that's a huge advantage that these startups have who are into YC and are going through the re-domicile process. So again, we are not underwriting companies, we are underwriting YC demo day. So if investors do not show up on demo day, then we are screwed. So however, YC has been around since 2005. And every year, even in difficult circumstances, there people do show up, and the reason for that are twofold. One is that 2% of YC companies in recent batches have become unicorns, and number 2 is 1/3 of these companies raise Series A, and their exits are about there's a tremendous amount of exits that do happen. I forget the exact number, but it is close to 20% of the companies. So the risk for investing sort of on a selective basis, or even if you do a spray and pray and you don't have a negative selection bias, I think you'll do fine if you go to YC. And that is our bet, and our sizing is such that we believe that the $1.5 million or million that the YC companies raise, they'll be able to repay our debt. And in case they don't, the average valuation, so if 2% of YC companies become unicorns, So the expected value of a YC company is 2% times a billion or 20 million. So if you don't pay me back, we convert your loan at 10 million. So in essence, at half the fair value. So that is the penalty. And therefore, like Apoorva was saying that they have very low NPAs, we also don't have any because people ain't dumb. So they figure it out and they repay us. But we give them the option and say, if you want to, we'll be happy to take more equity in your company.
Yeah. Got it. Yeah, that sounds fair enough. But are you looking to move beyond YC at any point in time in future?
So we already are, and the reason and the way we are doing it is through the benchmarking portal that we have created. So what we are doing there is we have seeded the benchmarking portal with about 1,000 data points of startups, where we have KPIs in every industry, sector, geography, etc. of companies. Now, if you as a startup come and give me your KPIs, we will tell you how you rank amongst your peers, over sector, segment, and geography, and also give you insights on your valuation, which is important today because you don't know where the market is. And in addition to that, if you have amazing traction, and we look at other things as well, like your pedigree of seed investors, etc., we will give you additional debt and we'll underwrite you for it. So it's a little data-driven model.
Yeah.
So, but that is not just YC, that's any startup.
Got it. Yeah, sounds fair. And Abhishek, how is it that you invest into your investee companies? What are the 4 or 5 metrics that you look at before putting in your money?
So Radhika, as I said, we are a thematic fund, right? For us, there are 2 considerations. One is it has to meet my requirement of a company where ESG considerations are relevant, right? The second thing is then we have 2 kind of companies that one is where we are largely driven by growth in the value of the business, where we are basically looking at a refinancing event where our capital will come back largely through refinancing. And unlike venture debt, typically, many of our businesses, I have to say that there is a re-rating of the company, right? So let's say I end up funding the capex of our project finance. My debt is used for a project finance or a capex or an acquisition financing. But over the next 3-4 years, once the acquisition has been integrated or the project has now fully come online and the revenue is much more stable, then the company will be able to raise either bank financing or much cheaper financing from an NBFC and then take us out. So that's one kind of companies where essentially you expect the risk to go down. The second is where companies which are generating free cash flow but are not typically asset heavy and are not able and have already tapped up their bank or secured deadlines and looking for that kind of money. So we have I would say very different companies which we're targeting. When many of them are brick and mortar kind of companies, even though we are looking at new age businesses, but bulk of our companies are companies which have assets or significant track record of generating cash flows. How much of it is free cash flow and can be used for reservicing us? That's where how we end up pricing ours.
Got it. I would like to now just do a hypothetical play wherein I want to ask all 3 of you, if there is a cap table and a founder is just too solid with his numbers, the team is good, and you see it becoming a unicorn, there are players like venture capital guys and venture debt players as well on the table. So why is it that a founder should go for venture debt instead of venture capital at that point in time? Is there any convincing point which can trigger a founder to choose debt over equity? Maybe we can start with Apoorva.
They should definitely take venture capital. Venture debt in no way can supplement the need of venture capital. It is just a complementary source, right? So I would just say that venture capital always has to be there. Venture debt is a subset. It makes a lot of sense for certain use cases, which we discussed, because it helps you preserve your dilution. Equity is the most expensive resource you've got, so dilute it wisely. But yes, having to say that you can just take venture debt and not raise venture capital, I don't think it's not a competition. It's more like a partner-centric approach. Venture debt also helps preserve dilution for the existing equity investors.
Got it. Ravi, any thoughts on this?
Well, if you get money from Sequoia A16Z, it's a signal. If you get money from a trifecta, it's not. right? I mean, that's a very different underwriting process. So again, the reason being that a venture debt player is saying, all right, my most important thing is I get my money back. Whereas a venture capital like Sequoia is saying, wow, is this going to be 100x? Right. That's
Yeah.
what gets me going. So that's more exciting bit. And if you get underwritten and invest, and your investor is somebody who believes in theory that you could become 100x, that's way better signal than somebody that says, I gave you 100 and you're going to give me back my 100.
So is this the excitement which is stopping more of venture debt players to come into India, or maybe the number is just very lesser than what it is for VCs?
I'm excited to be in India, so I don't think I have that issue. So maybe Apoorva can say why she has less competition.
No, so I think this ASI, there are more peers evaluating it once the TAM in general, the addressable market in general becomes big. And that has slowly become big over the last couple of years. India is a much more mature startup economy than it was, say, 10 years prior, right? So this asset class also has seen some bit of more maturity, some more interest from the LP base also, right? Because you need to see some industry cycles for your LPs also to get comfortable. We still don't have a lot of international capital in this asset class in India. We still don't have the likes of IFC, CDC, CPPIB investing in this asset class in India. So the growth is also a function of the interest of the LP community, which finds comfort after the asset class has been in existence for, say, 10 years, seen certain industry cycles, downturns, built conviction around the asset class, the performance of the fund managers, etc. So it has a lot to do with that. But having said that, there are definitely more players entering this asset class, just like we have revenue-based financing and newer anti-dilutive capital option available in the early stage companies. There are some players emerging in the late stage companies as well. So there is Evolution X, which is DBS and Temasek outfit. There is Allianz, JP Morgan, Nomura, who have started doing venture debt at a 20 million plus kind of check size. So they are extreme late stage companies, right? So I think there is a lot of interest in venture debt, definitely, and a lot of players in the early stage, late stage are now evolving. And I think as the asset class matures further, there will be more interest from the LP community, and you'll see more players emerging.
I would like to add that if you take a look at some of the companies that are still private, say in India, Zoho, right? They could probably, or Tally, which is the accounting software. These are mature companies, but if they take debt, it's still venture debt. Similarly, Stripe in America is huge, or SpaceX. If they take debt, that's still venture debt. So as more and more companies opt to stay private because of whatever reason, we don't have to do that here today, the venture debt size will increase. But in general, the structuring of venture debt is what is stopping people. So meaning that if you're an investor, you get a chance to invest in Sequoia versus Trifecta, you will always invest in Sequoia. So therefore, capital will always be more available for equity pool rather than venture debt because of that type of investor. Because as Apoorva said, institutions are not in yet. Most of these guys who are coming into venture debt or venture equity are wealthy individuals or family offices. Venture equity does have institutions, don't get me wrong. But in venture debt so far, the alternative that you have to venture debt is equity. So.
Got it.
Okay, so now we leave field open for the audiences if they have any question. We received some of them already, so in the written. So basically, it's one question is asked is, in fact, it's directed towards Ravi. If aren't you working too small if you are only funding YC entities? So if you like to take that question.
Yeah, I mean, I agree with that YC is small if you think of YC as but it is in a way 400 companies in a batch, last batch. This batch is 250 companies. They have 2 batches a year. So in theory, there are 1,000 companies in 18 months or so, every 18 months coming out. That's a huge amount of companies, and they're all fairly well vetted and they're global in nature. So in our last batch that we funded in YC, 1/3 of the companies were in America, 2/3 were international, including in India, Africa, Latin America, Southeast Asia, and Europe. So and Canada. So therefore, I believe that YC as a strategy may sound small, but it is not. However, our strategy is to go beyond YC for bridge to Series A and Series B, because we are only looking at YC because their demo day works so well. There is no other parallel in the market.
Second question we had is on the leasing side of things. Is venture debt being used for leasing transactions? If Apoorva, if you can answer that.
Yeah, so a lot of these furniture rental companies, etc., right, use a lot of debt, and not just venture debt, structured credit, etc. There are a lot of asset financing companies also, essentially. So yes, it's a very potential use case, and a lot of companies are using this.
The thing is, another question, related question was, do MSME companies get access to venture debt, or it has to be strictly venture capital backed, and only you get that this option opens up for you?
Strictly companies that are backed by institutional venture capital investors.
So if an MSME is institutional backed, then they can have that option. So
yeah, I mean, MSME is just a definition on your funding and asset base, right? So as long as it's a institutional VC backed company, of course.
Ravi, we are commenting something on that.
Yeah, no. So there's two types, right? So one, I would say, so in within the 8 family, as I mentioned, we have a VC firm which has invested in Blue Tokai. Now, that's certainly not a tech company; it's a coffee house, right? So I would call that an MSME, and that would still be venture backed. And but in general, if you're giving money to MSME, it would be more in Abhishek's sandbox, which would be MES.
Yeah, so why don't you tell us, Abhishek, how are you funding MSMEs these days?
I am by mandate, I am supposed to target MSMEs, but SMEs as defined by European Union. So their SME definition is fairly. These are typically, I would say, these are mid-sized companies. Typically, so for me, it will be very difficult to look at a company less than 50 crores in revenue. And 50 crore would be a company which is operating at some, which are on in a healthy margin business. We look at a lot of companies which are, which are basically trading in commodities and all that. These companies, I will not look at anything less than 100 crores or so. My understanding is that I think Indian definition is less than 100 crores of revenue for SME, and I think MSME is much less.
Okay. The question we have from the audience is, a lot of media tech or content tech companies have seen stable and predictable revenues coming in from monetization of their content on digital platforms like your OTT. Do you see an increase in such companies going for venture debt? Have you made any investment in any such company? And if yes, what has your experience been thus far? Apoorva, you can start with that.
Yeah, so we are invested in Pocket Aces. It's backed by Sequoia, 314, and other investors. And yes, the experience has been great. Of course, these companies have high margins. If you have a content order book, as I was saying, right, even for products as companies. Similarly, in this case, if you have an order pipeline, confirmed orders from, say, Amazon, Hotstar, various OTT platforms, and there is some bit of front ending of expenses for which you are taking debt, of course, you can take debt, and then the repayment can be planned as per the cash collection cycle from your customers.
Got it. But like you said, it was a great experience for you. It was a great experience for us also, including the audience for the webinar. It's almost time. 6 o'clock, didn't realize how it went by. But just like how debt comes and goes, you don't realize. Just the time also went by. But really, really good having you guys on board. Thank you so much, Ravi, Apoorva, and Abhishek, for your time. I'm sure the audience also has taken a lot from this interaction, and we'll keep having such more webinars around these topics for our audience to get educated about venture debt. But with this, we sign off and thank everyone who joined in today.